Mr. Speaker, I rise today, or rather stay risen, in support of H.R. 4061, the Financial Stability Oversight Council Improvement Act of 2017. And I want to commend two friends, Mr. Ross of Florida on the Republican side of the aisle and Mr. Delaney on the Democrat side of the aisle for their collective leadership on bringing forth this truly bipartisan bill, a strong bipartisan bill which has 58 different co-sponsors, half from each side of the aisle. Before talking a bit about the bill, there has been a lot of news today, Mr. Speaker, and part of the news that I just could not overlook is the fact that my dear friend and colleague from Florida announced that he would be retiring at the end of this Congress. I do want to say what a pleasure and honor it has been to work with the gentleman from Florida. I have appreciated his leadership. I've appreciated his knowledge. I've appreciated his calm demeanor and his ability to further strong bipartisan measures that will help create greater credit opportunities for hard-working Americans. I would say I will miss him, but I will be gone as well. So maybe he will invite me down to the Florida coast for some deep-sea fishing. I look forward to receiving that invitation at the appropriate time. Now back to business, Mr. Speaker. The Financial Stability Oversight Council is charged with identifying emerging threats to our financial stability. However, during the previous administration, the FSOC, as it is called, went far beyond identifying this risk and instead just concocted incredibly irrational, speculative scenarios about sectors of the financial markets that had nothing to do with the financial crisis. And in turn, they have caused more harm to the financial system than added stability. It bears highlighting at the outset that this bill does not strip the FSOC of its ability to designate a non-bank financial company as a SIFI, or systemically important financial institution. Frankly, Mr. Speaker, it'd be a better bill if it did. It also wouldn't be a bipartisan bill. So that's not what this bill is trying to do. Rather, the bill simply brings needed transparency and accountability to the designation process. Mr. Ross and Mr. Delaney in H.R. 4061, they do this by reversing the presumption that government bureaucrats should dictate the business models and operational objectives of private businesses and requiring the FSOC to approach the potential designation of a non-bank by encouraging companies to address the risk prior to designating SIFIs in order to actually reduce systemic risk. So let me sum it up, Mr. Speaker. All this is saying is a non-bank financial institution that the Financial Stability Oversight Council feels may be creating undue risk in the system, give them an opportunity to remedy that before you designate them as a too-big-to-fail institution backed up with a taxpayer bailout fund. At least give them an opportunity to remedy the risk that you're concerned about. What could be more common sense? What could be more reasonable? That's why it's such a strong bipartisan bill coming out of the House Financial Services Committee. Specifically, Mr. Speaker, applying bank-like regulation to non-banks, such as asset managers, broker-dealers, insurance companies, or private investment funds just doesn't make sense. Non-banks do not have access to the deposit insurance fund. They don't have access to the Federal Reserve's discount window or lending facilities. And non-banks take far larger capital haircuts on the assets they hold. And non-banks, when they fail very differently from banks. If an individual mutual fund were to fail, the shareholders of that fund would bear the losses, not the taxpayer. There is no reason to apply the same system to them. So the bill it would bring, again, clarity and accountability to the FSOC designation process. That should be self-evident. To date, the FSOC has designated 4 non-bank financial companies as systemically important financial institutions. Today, only one remains designated, and it's unclear for exactly how long. The de-designation of these companies seems to point to a recognition that these companies do not present a potential risk that FSOC first claimed that they did. MetLife, one of them, actually challenged FSOC's SIFI determination in court, and FSOC's designation was found by an Article III judge to be fatally flawed, arbitrary, capricious, and a critical departure from FSOC's own standards. Based on that case alone, it certainly seems appropriate for Congress to ensure that proper guardrails are put in place in this designation. Because at the end of the day, the designation doesn't just affect, again, Wall Street. It is felt directly by Main Street households who are trying to save for college, save for retirement. They would see their cost rise and their investment returns fall on a mutual fund if it was designated, simply because investors would be required to bail out other too-big-to-fail firms. So this is a common-sense piece of legislation. It is strongly bipartisan, and I urge all members to support it. I reserve the balance of my time.